Let's welcome in Sunil Subramaniam, CEO at Sundaram Mutual Fund. He's now joining us. Mr. Subramaniam, you have a new microcap fund offering that has been launched. Can you just give our viewers more details about it?
One of the key things, if you notice in the market, is that the valuations which have been kind of rising because of FII flows and domestic flows. One of the key things about the FII flows is that they are restricted to the top 100 stocks. Right, so the valuations at the top end and the bottom of the curve, there is a significant difference, especially if you factor in future growth prospects. What we have found from our study in the past is that when the economy goes through a bullish phase, the smaller cap actually delivers double or triple the value. For example, I'll give you an example. 2003 to 8, we use this as a benchmark in terms of a bullish phase of economy and markets. At a time that the Sensex then multiplied about 5.5 times, the mid-caps multiplied 9 and the small caps multiplied 14 times. So we see that today we are in a phase where the economy is in a bullish phase. Valuations are also rising because domestic flows are strong. But at such times, what happens is the smaller end of the cap curve actually delivers far better value. The only caveat there is that you have intermittent volatility because of the earnings and the way their prospects turn out. So you need to stay invested for about 5 years at least, 4 to 5 years. So what we are launching is a series of close-ended microcap funds which will buy and hold these stocks which are very closely economy sensitive, highly cyclical kind of stocks for a 5-year period. And what we are doing there from an investor perspective is that we have a dividend option and a growth option. And what we've been doing there consistently, this is our 15th launch of microcap since the last 3 years. What we do there is we book profits whenever stocks run up and we return the money to investors back as dividends. So if you take the first 3 microcaps that we launched in early 2014, for example, 100% of the investors' money has been given back in the form of dividends. So today that investor's money is entirely profit sitting in the market, which is already on a 40% appreciation. So if you look at that way, this segment is ripe in terms of the fact that over the next 5 years, we believe that India is into a very bullish economic growth phase. These kind of stocks are going to outperform, and with a buy and hold strategy, we can actually deliver a lot of multi-baggers within the portfolio and give healthy returns to investors. So that's the reason we are launching this. We launched one last month. We are launching one in the coming weeks too.
Right, but what does this? I think investors cannot do SIP into this. So is it a close-ended fund?
It's a closed-ended fund. So what we are doing is we are launching one practically every month. So if you really want to do an SIP, you have to do an allocation to every one of our NFOs. So that effectively you are achieving the SIP status. But you are right. Once the fund closes after the NFO, fresh applications cannot be taken.
Right. So don't you think it will limit the number of people that you are catering to? Because people always look for lump sum. People always look for SIP investment rather than lump sum.
Yes, to that extent, the closed-ended fund cannot cater to the SIP set of the audience. So that's definitely something that we miss out on. But we find that there is enough interest from people who allocate reasonable amounts on lump sum investments to this. So yes, this is not an SIP-oriented product, that I agree. But there is enough interest in terms of people, getting the lump sum monies and putting them into it. And since we are giving regular launches, those who have been supporting us in our distribution community over a period of time know that every month from their customer, instead of just locking out an SIP, they just take an application form into this fund.
Right. In terms of SIP culture, can you just tell us, even though you're launching this, it doesn't mean that the SIP culture is changing. Still, the flows in most of your well-performing funds are decent?
Excellent, in fact. The numbers that we have from our company from January onwards, every month the SIP book has been rising 10% over the previous month. And even for the industry, we are running at around 4,400 crores a month of SIP flows. So on an annualized basis, that's 50,000 crores of inflows into the stock market. And mind you, the mutual fund industry equity segment is only 6 lakhs crores in size. So what we are saying is that 8 to 9% of the industry's size is being added to SIPs every year. So definitely a very significant, strong, healthy uptrend. And our select midcap and our rural fund, which have been doing very well, do get a very good share of SIP flows. It's not that you are missing out on the SIP flows, just that this particular microcap segment being closed-ended doesn't get the SIP money.
Right. Can you just talk about the AMC business as a whole also for us? a lot of people always say that from 2013 to 2016, 17, we've seen this continuous rise. Can you still tell us, a lot of brokerages are betting that more than 20% growth can happen into the mutual fund industry on a CAGR basis in the next 3 to 4 years, till the time the share of equity investments increase. As a CEO of an AMC, can you just tell us, is it possible?
No, absolutely. So if you look at the industry's mix today, right, this 2/3 of the industry is in fixed income and 1/3 in equities. So on an 18 lakh crore industry, you're talking about 6 odd lakh crores in equities and about 12 odd lakh crores in the debt side. And the debt side also roughly between the money market segment and the medium-term debt segment is roughly 50-50. So roughly, very macro perspective, the industry is divided into 3 equal parts. One is the equities market, which is largely retail, largely individual. Then secondly, you have the debt segment where you have some institutional play, but a lot of HNI play, because HNIs look at the tax advantages of debt mutual fund if you hold for 3 years vis-a-vis bank FDs and put their money in there. And they're also more savvy in terms of the interest rate curve. And then you have the money market segment, which is largely institutional driven, which is more of a preserving capital. And since there is not much of an outflow in terms of capex from the private sector today, a lot of parking is happening in mutual funds. So if you look at the growth of these 3 segments over the next 3 years, the equity segment is the one which is going to grow the fastest. So one of the reasons for that is that, first, the market itself should grow at least at 2 to 3 percentage points more than the nominal GDP of the country. So today, if you look at our GDP at 8% and an inflation rate at hovering around 6%, you're talking about 14% as a nominal GDP growth. So I think, right, large caps should grow at 16 to 18% and mid caps and small caps should grow at 20 to 24%. So if you then take the rule of 72, then you see that means that on a weighted average, the industry is going to grow at, let's say, 18%. In 4 years, this should double. So the 6 odd lakh crores of equity should become 12 odd lakh crores in about 4 years' time. At the same time, the debt segment, increasingly what's happening is the HNI segment, which is investing here, and the institutions. What is happening is that bank deposits are today trading at 6.5%. Post-tax, if you take, you're getting a 4% yield. So whereas in the debt segment, today also, you're able to get 6.5% in the shorter in the curve and about 7.5% in the longer end of the curve. So clearly there's a tax-driven, value-added return that can come to the investor base. So incremental flows are going to shift from your fixed capital instruments like bank deposits into the debt segment of mutual funds. So even there, if you take a conservative growth in terms of flows, right, as I said, the return itself should be around 7%. If you add to that, you add a flows to about 10% of that. Again, a 17-18% growth in the debt segment is not a difficult task. So even that segment, 6 lakhs, should go to double of the 12 lakhs. It's the third piece, that is the money market segment, where while there are flows coming in and money market funds are returning about 6% and all that, those flows for the next 12-18 months will be very strong because we don't see corporate capex will take time to pick up. But maybe 18 to 36 months from now, you will see some of that money actually get invested into real assets in the economy and there could be a flatter rate of growth. So the liquid money market segment, I think assuming a 10 kind of a percent growth over the next 3 to 4 years. So if you see 10% growth, if you say for 4 years, 40 to 40%, so let's say half the growth. So if you look at then from my computations, right, that I've just run through for you, so you're going to have equities at about 12-13 lakh crores, debt at about 12-13 lakh crores, which should take it to 25 lakhs crores, and you should have money market segments at another 10 lakh crores. So you're talking about 35 lakh crores. So 18 lakh crore industry doubling to 35 lakh crores in roughly 3 to 4 year time frame is not too difficult a task, and we think is eminently possible. So the industry definitely is on that 18-20% growth trajectory today.
Right. So, when a lot of people look at banks, when a lot of people look at NBFCs, as of now, there is no valuation which is given to any AMC or any great broking business, even if some of these banks or NBFCs have. Do you think that could be a very interesting growth area, apart from financials, private banks and, the urban NBFCs? A lot more, flows could come into, a lot more wealth could be created into other financial institutions as well?
Yes, absolutely. You're talking about the financial institutions listed in the stock market, and the wealth creation can happen by buying those stocks, right?
Right.
Yeah. Yes, absolutely. See, it's very simple. If you look at it, since inception of the Nifty and the Bank Nifty has delivered 3.5 times the return the Nifty has delivered, right? There are two reasons for this. One is, 1/3 of FI allocations are into the financial services segment. Why do FIIs invest so heavily? And roughly 40% of the mutual fund diversified portfolios are also in the financial services segment, banks included. So why do they do this? Because generally the financial services are both the driver and the beneficiary of economic growth, and they are the best base. Second is that because they are the driver and the beneficiary, the kind of scalability that financial services can show. Now, if you take the top names like HDFC Bank, Bajaj Finance, whatever those kind of names, if you look at the kind of 10-year CAGR in their assets, we are talking about 20 to 30% per annum at least in CAGR, and stock prices have kept pace with those kind of asset growth. The scalability of financial services business is one of the key reasons why they are very good investment bent in a growing economy. The second aspect is, like you mentioned, is that the depth of the market in the financial services is going to expand phenomenally. One big segment there is insurance. We have one company only which has listed so far. We have another which has said that they're going to list next year. And you're going to, the need for insurance money, capital markets to finance the whole insurance growth is phenomenal, because our per capita penetration of insurance in terms of premium per capita is very, very low compared to the other developing countries. The second aspect there is the new payment banks, microfinance banks, the new financial inclusion related players which are coming to the market. The third aspect would be companies like ours, like asset management companies, right, which hardly anybody is listed in the market today. But over the next 3 years, you'll see a lot of these companies. Now, if you look at insurance and asset management, they are all asset-light businesses, right? Whereas the lending, typical financial services is a lending business. So there's a capital needed and growth. But these asset-light businesses can give phenomenal return on equity when they list and they scale up. So the opportunity from the financial services domain in the capital markets is simply phenomenal. And I think half of the industry has got specific financial sector funds. There are about 18, I think, out of the 40 AMCs have financial services sectoral funds. And these will be the ones which have been already outperforming, will continue to outperform in the coming days and years.
Right. Mr. Subramaniam, the consensus belief is that the private sector banking space is a safe bet for improved earnings visibility. Now, recently we've seen all the private sector banks have increased provisioning. There's been a little addition in slippages. What's your view now from now on? Do you think the expectations are just too high for private sector banks, and small slip-ups can lead to a lot of disappointment?
I would actually hedge my bets there, because see, the valuations are high for a reason, because the consumption boom in the country got delayed because of demonetization is actually going to play out in the second half of the year. What the valuations are reflecting is a strong surge in consumer finance and all the rate sensitive sector like auto, consumer durables being now purchased through the financing now, and that's why retail financial players valuations are quite high. And when you said that they are considered safer, what is the meaning of safe is the opposite of risky, right? So while the valuations are high, there's a reasonably higher degree of confidence that these high growth numbers would be delivered. So the riskiness of investing in these, albeit high PE stocks, is that the return that you get may not be super extreme because there is no valuation pickup, but the growth definitely should justify the kind of investment at these levels. So they are safer bets, but if you want alpha in your portfolio, then there are a lot of value picks. Basically, corporate lenders are the ones which are trading at low valuations today. And the NPA cycle is, while it's bottoming out, is not yet through. Hence, valuations on that space are definitely much lesser. So if you're looking at a 3 to 5 year perspective, though the corporate lenders are a riskier asset class, they're probably going to deliver much better capital appreciation. But the retail financial players that you mentioned are safer, because the slippages that you talk about because their risk is spread over thousands and millions of retail customers, right? It's a book, it can be managed better than a corporate lender where a few big loans going bad impairs the portfolio quite suddenly. So I think that the risk diversification that retail financial players enjoy would take care that these slippages can be absorbed in a rising growth scenario.
Right. Mr. Subramaniam, then how safe would you think PSU bank stocks would be? I'm not talking about the tier 1 PSU bank stocks, but the tier 2 PSU bank stocks. There is an expectation that the government is very soon going to announce a plan to tackle the debt mountain, the bad debt mountain that PSU banks are tackling with. And today we are seeing strong up moves coming in some of the mid-cap PSU banks. Are they safe bets at all?
Oh, well, it's a matter of timing. Okay, not timing, I'm saying time in the market. So if you are going to look at it over a 12-18 month perspective, yes, they will carry a higher degree of riskiness. But if you're willing to wait the period of, let's say, 3 to 5 years, then we believe that the PSU banks definitely represent incremental wealth creation value. There is higher risk, but there's a higher reward at the end of the tunnel. Why are we saying this? For 2-3 reasons. One is the government is pretty serious about cleaning up the NPA. So this is a 3-pronged process that the government is going to do. One is there will be an attempt to create a kind of a bad bank where some of these more toxic assets can be parked, and maybe the capital market given a chance to value these and park them out of the normal banking. Second will be the mergers where the weaker among the PSU banks, which are not having enough capital to manage this kind of rising NPA, would be merged into healthier, stronger banks, and overall, in the process of the merger, there will be revaluation of their existing fixed assets and the business model will change. There will be reduction in cost because common branches can be shut down and VRSs can be implemented. So the merger will be the second. And third is actual capital infusion, where many of these banks will be asked to go to the capital markets to raise capital. So this combined 3-pronged strategy of the government, right, we believe will pay off dividends. And the advantages that the PSU banks carry, which very often the market ignores, is first of all, is that if you look at it from a penetration, financial inclusion, the number of Jan Dhan Yojana accounts, right, it is the PSU banks which have got the lion's share of it. So they've just got this huge influx of new bank accounts thanks to demonetization. They've got low-cost deposits now, and there's a huge book. Second is that the PSU banks among those which hold the highest of government securities, much above their SLR, CLR requirements in terms of government securities. So in a kind of a flattish, slightly declining interest rate scenario over the medium term, they will get good capital gains from their government security holding book. The third thing is that these are primarily corporate lenders, but they are learning the act in retail lending. And so we see that they will be getting a fairly decent share of the incremental consumer finance which happens in semi-urban rural areas purely because of the strength of the relationship with their customers and the thing. And the fourth and the final thing is that ultimately, in a 12-18 months period, when infrastructure, private sector infrastructure comes back into the economy, right now it's a government-driven only, the infrastructure boom. The private sector, when they enter into it, the financing has to be done by the public sector banks because that kind of a capital availability and reach nobody else has. So my point of view is that yes, in the short run, you will get surprises. You will see suddenly valuations going up, maybe correcting. But if you're willing to hold for a 3 to 5 year period, there is immense value. And in our portfolio also, wherever we are having a slightly longer term allocation, we have started buying more of public sector banks into our portfolio. And in fact, next Monday, we are launching what is called a value fund. Now, you might be a bit surprised that in this kind of high valuations, overall perceived high valuation market, how are we launching a value fund? The value fund essentially is one of the components of this value fund will be to buy into good quality public sector, corporate lending kind of banks and hold them for, this fund is a 4-year closed-ended fund, and hold it for that period because we definitely good wealth creation potential by doing a buy and hold on these kind of banks.
All right, Mr. Subramaniam, thank you so much for speaking with us at NDTV Profit, giving us your views on flows, on markets and sectors.